we have this interesting situation and challenging situation in Australia where we have inflation growing at about double the rate of economic growth. So that inflationary pressure is putting pressure on households. We also have some fairly strong capacity constraints in areas like housing and energy markets, which are also creating inflationary pressure. So what we're doing in our businesses, particularly our large retail businesses, is we are well regarded and trusted in the market in Australia and New Zealand for everyday low prices. So when households are doing it tough, we really lean in, keep our prices low. We're able to achieve that through a relentless focus on productivity and expanding our addressable markets by bringing new categories to our stores and to our online channels. And that has served us exceptionally well over the years. When we saw inflation start to kick in post-COVID, we adopted the same strategy. And because of the trust that customers have in our everyday low pricing, we were able to grow our sales, grow our earnings, and take share. So we're really leaning into this as an opportunity to help customers and also grow our businesses.
Yeah, Rob, I understand that one of the ways that you're helping to, I guess, alleviate or temper some of the operational cost pressures on your side is through this new initiative you tied up with the Google Cloud, partnered with them in agentic AI. Can you give us visibility or a bit more detail in terms of how that could impact your margins and also your productivity in the next, say, 12, 24 months?
Sure. Martin, we're delighted to enter into strategic partnerships with both Google Cloud and also with Microsoft. And both partnerships are very deep, are very strategic, and will help us continue to transform our businesses. And this is really an acceleration of our existing strategies. To give you some examples, on the agentic commerce side, we want to make sure that our brands and our retail businesses are the first choice for customers that are engaging through conversational commerce and agentic commerce. So really building the connectivity there. Also, we see opportunities for productivity improvements through enhancing team member effectiveness in store, improving customer service. We also have a number of programs of work underway in areas such as merchandising and supply chain. So we are really excited about this, and we want to make sure that we are bringing the leading technologies to market in Australia for the benefit of our customers and our businesses.
All right, Rob, let's get to lithium. Your covalent lithium business, the whole refinery, the ramp has been delayed. It has been a little bit off target or track because of intermittent issues, which we won't get into here. But what I want to know is, have those issues been resolved? One, and in terms of impact on your earnings, 2H, what can you tell us?
Sure. Well, look, we're actually really pleased with how our lithium project is going and how the commissioning is progressing. We are somewhat unique in that we have a vertically integrated mine, concentrator, and refinery. The mine and concentrator are performing really well. We've been selling spodumene. We delivered our first product for the first half. We also signaled that we're expecting the profit to increase in the second half slightly. So this will be a profitable year for us. We're still working through the commissioning of the refinery. These are complex processes, but we're very confident that we'll get there and be a very reliable supplier of lithium hydroxide in the future.
And Rob, you know, investors should be, I stress, should be pretty happy with your capital management, right? And the way you've maintained pretty strong capital returns. You've had distributions, growing ordinary dividends, which you referenced just a couple of seconds ago. How do you balance that, though, with preserving balance sheet flexibility for potential future investments, potentially even including M&A?
Well, Martin, we like always having a strong balance sheet and retaining that financial flexibility, both to invest in our existing businesses, but also to take advantage of opportunities that come from time to time. We're investing heavily in our businesses, investing in new technologies, the continued development of our lithium business, our healthcare business, a lot of reform and upgrade of our retail stores. So we're really fortunate to have that strong balance sheet. I think what has worked for Wesfarmers over many, many decades is that discipline about capital investment. There are good types of capital investment and there are value destroying forms of capital investment. We're not afraid to invest, but we want to make sure that we're investing to deliver benefits for our businesses and benefits for our shareholders.
Rob, help us look ahead. I mean, potential drivers for Wesfarmers going forward. I can think of a couple of Wesfarmers Health. One, omni-channel retail. Two, and, generally sort of other emerging areas. Can you give us a little bit more, put some meat on the bones, flesh it out, what you think the drivers will be for sustainable earnings growth as well as shareholder returns over the next, say, 3-5 years?
Sure. Well, look, we gave a fairly short-term update on our trading performance for this second half, and we talked about a continuation of the positive sales momentum we had in both Bunnings and Officeworks, and we talked about an improvement in sales in our Kmart group. So I believe that our retail businesses are really well positioned to continue to grow in what is a more challenging consumer market, and we have demonstrated good operating leverage within our retail businesses. I'm really excited over the next 3 to 5 years in the further opportunities for our lithium business. We have opportunities to invest in more capacity for our mine and concentrator. We're expanding our chemical manufacturing capacity in ammonium nitrate, sodium cyanide. We see lots of opportunities to accelerate the transformation of both our health division and Officeworks. So there's a lot of growth within the existing portfolio, and then our balance sheet is well positioned should new opportunities come along that would add value for shareholders.